Hey everyone, and welcome. Today we are going to pull back the curtain on the financial story that every single business tells. We're going to break down the two most important reports you need to know so you can understand if a business is just busy or if it's actually successful. It's time to crack the code behind the numbers.
You know, this is the question. It's what keeps entrepreneurs up at night. The phone is ringing, you're making sales, products are flying out the door, but at the end of the day, at the end of the year, are you actually any better off? It is so easy to confuse all that activity with real progress.
So how do you get a true picture of a company's health? Well, it turns out you can't just look at one number. You actually have to answer two totally different but equally important questions.
Okay, first you have performance. This is all about how the business did over a stretch of time, like last month or the entire last year. It answers the question, how did we do? Then you have position. This is a snapshot of your business on one single day. It answers, where are we right this second? The best way to think about it, it's like a movie versus a photograph.
And the great news is, we don't have to guess the answers to these questions. The world of accounting has given us the perfect tools to tell these two very different stories. They're called financial statements, and each one is designed to do its job perfectly. So let's dive into that first story, performance. To get this story, we use a report that's usually called the P&L. And I want you to really stick with that movie analogy. It has a start date, it has an end date, and it shows you all the action, all the drama that happened in between.
Now, its formal name is the Statement of Profit or Loss. And honestly, the name says it all. It scoops up all your sales, all your costs, and all your expenses over a specific time frame, does the math, and tells you if you ended up in the black or in the red. And that is the absolute key thing to remember about the P&L. It's always about a period of time.
And the formula here is actually super logical. You start at the top with your total revenue, right? All the money you brought in from sales. Then you take away the cost of sales. That's what it directly cost you to make what you sold. That leaves you with your gross profit. But we're not done. From there, you have to subtract all your other operating expenses, things like rent, salaries, marketing, electricity. And a word of warning, a lot of businesses get into trouble right here by not tracking these carefully. What's left over at the very bottom, that, my friends, is your net profit, the true bottom line.
So this quote might sound a little technical, but the idea is actually really simple. Think of the P&L as hitting a reset button at the end of the year. All those accounts that track your sales and your expenses for the year, they all get bundled up, summarized into that one final profit number, and then they're closed out, basically wiped clean, so you can start fresh at zero for the next year.
All right, let's switch gears and talk about our second story, position. So if the P&L was the full-length movie of your year, this next report is the snapshot photo. It tells you exactly where your business is financially on one specific day.
This is the Statement of Financial Position, but almost everyone just calls it the balance sheet. And its whole job is to give you that snapshot. It's not about what happened over the last year, it's about a single moment in time. It answers the questions, what do we own and what do we owe right now, today? And the whole thing is built on this one simple, kind of beautiful equation. Assets equals liabilities plus equity. It's the core of all accounting. What it means is that everything the business owns was paid for by one of two things, either money it borrowed or money the owner put in. That's it. And it always has to balance. So let's break down what each of those three things are.
First up, assets. Put simply, this is all the stuff the business owns that has value. We're talking about the big things like buildings or company cars. Those are called non-current assets. And we're also talking about things that change more often, like cash in your bank account or the inventory you have sitting on the shelves. Those are your current assets.
Next up, liabilities. This is pretty much the flip side of assets. It's everything the business owes to other people. It could be a big, long-term bank loan you're paying down, or it could be short-term stuff, like the bill you owe to one of your suppliers. And honestly, this is where you can often spot trouble, when what a business owes starts to creep up on what it owns.
And finally, we have equity, which you'll also hear called capital. This is the owner's slice of the pie. It's what the business is really worth to them. The simplest way to think about it is this. If you sold off all your assets and used that cash to pay off all your liabilities, whatever money was left over, that's your equity.
Okay, so we've got our movie, the P&L, and our snapshot, the balance sheet. On the surface, they seem totally separate, right? One tells the story of a whole year, the other is just a picture of a single day. But this is where the magic happens. This is where it all connects.
Take a look. Here's the final scene from our movie, a simple P&L for the year. We start with our sales, subtract all our costs and expenses, and we get to our big finale. The hero of our story is that bold number at the bottom. Net profit for the year, $2,695. Now burn that number into your brain for a second.
So what happens to that profit? Does it just disappear in the thin air? No way! That profit, the result of a whole year's work, flows directly into the owner's stake in the company. It literally makes the business more valuable.
And check it out, here's exactly where it lands. This is the equity section of our balance sheet snapshot. We see the owner's capital at the start of the year. And then, look, there it is. That $2,695 net profit from our P&L gets added right in. Now, we do have to subtract any money the owner took out for themselves. That's called drawings. And what we're left with is our new, updated capital at the end of the year. See, the end of the movie directly changed the final photograph. That is the connection. It's brilliant.
So why did we go through all of that? Because understanding how these two stories connect isn't just some boring accounting exercise. This is about taking numbers on a page and turning them into smarter, real-world decisions for your business. When you can actually read and understand both of these reports, you unlock some serious power. The P&L tells you if your basic business idea is even working. The balance sheet shows you your financial strength today. And when you look at them together, year after year, you can spot trends, plan for growth, and walk into a bank for a loan with real confidence because you know exactly what's going on.
Look, at the end of the day, these financial statements are telling a very detailed story. They whisper to you when things are going right, and they shout at you when something is wrong. The only question left is, now that you know the language, are you listening?